Okay, so we were discussing about a mutual fund. Now moving on to the net asset value. So net asset value is the current market price of each unit of a mutual fund, right? Like there is a share price for each share. Likewise, there is a current market price of each unit of a mutual fund. So that is known as the net asset value. It is basically an average of all the, in very simple terms, it is a weighted average of all the share prices which are there composed in a mutual fund. Okay, that is NAV. It will be fluctuating daily. It depends on the, how the share or how the stocks or how the securities in the fund are performing. Why I'm saying securities, because along with equities, there is going to be a debt exposure as well. There might be some other securities which might be part of the fund too, right? As a hybrid fund, balanced fund, right? That are good examples of it. Sale price is the price you pay when you invest in the scheme. That is the offer price, right? Then there is, it will be the sale price minus NAV will be the entry load. So NAV plus entry load will give you your sale price. Then there is repurchase price at which the units are repurchased, redeemed by the MF. NAV minus repurchase is equal to exit load. So whenever you want to redeem a fund, if there will be limits as per different funds. Once that NAV, whatever the NAV is at that time, along with that, there will be an exit load sometimes, maybe there won't be, that will be the repurchase price. So one of the features of a mutual fund is that it is very low cost, because there will be many individuals who will be investing, who will be pooling their money together with a mutual fund, right? So it leads to economies of scale. So they are relatively very less expensive rather than directly investing in the capital markets, because the overall share brokerage is reduced, right? So that's how it is low cost for the investors. Liquidity: in open-ended schemes, you get your money back promptly at the NAV related prices from the mutual fund itself. With close-ended schemes, you can sell your units on the stock exchange at prevailing market prices. Here, there won't be any more further transactions with the mutual fund itself. You can, if you require the money, if you want liquidity, you will have to sell it on the stock exchange to some other buyer. Transparency: so you get regular information of your value of investment, along with where this fund has invested, how much has been invested in these securities. Let's say 10% into real estate, 10% into debt, 80% into equity, just an example. And along with that, whatever is the fund's investment strategy, or what is the outlook for the next 1 year, 3 years, 10 years, all that is being conveyed. If you are a mutual fund client, it will be conveyed to you through the company. That is transparency. Flexibility through features such as SIP, systematic investment plan. Then there is SWP, that is systematic withdrawal plan. And dividend reinvestment plans. You can systematically invest and withdraw funds according to your needs and convenience. So just a small point on dividend reinvestment plans. Earlier, I was talking about a reinvestment risk, right? Where as an individual, you or me are not able to invest the dividends or whatever profits that we make into someplace better. The company can make better use of these funds. Hence, instead of giving or offering the dividend to us, the company gives an dividend reinvestment option, where we say, or the person says, the individual says that you do not need to give me dividend, or you reinvest it back into the fund, back into the, in terms of a company, back into the company's funds capital. Okay. Mutual funds are registered and well regulated by SEBI. the investment an investor makes in a scheme is translated into certain number of units in the scheme, and these number of units are multiplied by the face value 10 is the capital of the scheme. Okay, so what we earlier discussed, we talked about NAV, which is the price per unit, and if an NAV is multiplied into the number of units, that is where you get your total AUM. When profitability metric is positive, the true worth of an unit, also called as NAV, goes up. So if, let's say, there are 10 securities in one fund and 8 of them are in profit today and 2 of them are in losses, that means 8 of them are in green, 2 of them are in red. So the overall average is taken and the NAV of the fund will go up for the day. Okay, maybe the next day 6 of them are in red, 4 of them are in green. So depending on what is the exposure to each of these securities, the overall profitability or overall NAV of that fund is calculated. So when a scheme is first made available for investment, it is known as an NFO. You must be obviously aware of this, NFOs. The NFO at the NAV at the beginning at the NFO offer is 10 rupees. The relative size of mutual fund companies is assessed by the assets under management. The AUM captures the impact of profitability matrix and the flow of unit holder money or from the scheme. Lack of portfolio customization and overload of schemes and scheme variants are drawbacks of mutual funds. The drawbacks are very limited as compared to the pros. Pros are very much higher rather than the cons here in terms of mutual fund. You get diversification, you get exposure to great stocks that you wanted. You do not have to do the research yourself. You can invest into a fund and the company will do the research for you. So these are the benefits outweigh the cons in terms of a mutual fund. An investment objective defines the broad investment charter. The policy describes in greater detail the kind of portfolio that will be maintained. The strategies decided on a day-to-day basis by the senior management of the AMC. Okay, so all these objectives, once the investment has been done into that mutual fund, there will be several outlook letters, mails that will be shared where different the status of that mutual fund per month, the number of units, the outlook, what kind of a portfolio that fund is holding, all of that will be shared with the investors and sometimes with potential investors as well. Open-ended schemes do not have fixed maturity. Investors deal with mutual fund for your investments and redemptions. The key feature is liquidity. So यहाँ पे investors अपना open-ended scheme में कभी भी buy and sell कर सकते हैं from the company itself, from the mutual fund company itself, okay, at the prevailing NAV. So this is a open-ended scheme. कभी भी खरीद सकते हैं और बेच सकते हैं कंपनी के साथ. Okay. ओपन-एंडेड में वैसा होता है. क्लोज-एंडेड में you will not be able to sell it back to the company, sell the units back to the company. आपको किसी और को बेचना पड़ेगा in the stock market or in the exchange. Investors can sell their units to a scheme through a repurchase transaction at a repurchase price according to the NAV. Close-ended schemes have a stipulated maturity period. They are called close-ended schemes. Investors can invest in the scheme at the time of the initial issue and thereafter buy or sell units of this scheme on the stock exchange in requirement of money. Otherwise, they can wait till the maturity period is over. There are also interval schemes, which are a combination of open-ended and close-ended funds. Okay, there is a period in this scheme where it becomes open-ended. It is called as the transaction period. In this period, between the close of the transaction period, it is known as the interval period. That is where the transactions can be done. That is where the scheme can be bought or sold. Minimum duration of this transaction period is 2 days. minimum duration of interval period is 15 days. Scheme should be compulsory listed on stock exchange during this interval period. So during this interval period, there will be exchange of units of these schemes. Now, after talking about close-ended and open-ended funds, let us move on to active and passive funds. So actively managed funds are funds where the fund manager has the flexibility to choose the investment during a certain period of time. Let's say in 1 year, the composition of the fund will change according to the market conditions. That is, the fund manager will be making changes, will be actively managing, will be buying some, increasing exposure into some stocks, maybe decreasing into some stocks or securities. Okay, but the total investment objectives of the scheme remains same. Okay, still the composition, that is the investments, will change, will be increased or decreased according to the fund manager. But also, due to this high active management, the expenses for these funds will go slightly higher, but keeping in mind that it will also, the actively managed funds will also provide a slightly higher return because of the changing composition. Then there is a passive funds which invest on the basis of specific index whose performance it seeks to track. Okay, a very good example of this will be an ETF, where it is a passive fund which does not require active management. It will just mimic an index. It will just mimic any benchmark that it has taken to itself. So the performance of these funds tend to mirror the concerned index. They are not designed to perform better than the market. Okay, they are only designed to mimic. So a passive fund will not be doing much of changes. It will just mimic the index. In passive funds, the portfolio is determined by the index itself. The fund manager has no role in deciding the investment. Therefore, due to low, let's say, active management, the schemes will have low running costs. SEBI categorization. So there are these categories of mutual fund schemes. So we have 11 equity schemes, we have 16 debt schemes, we have 6 hybrid schemes, and 2 solution oriented schemes, and 2 other schemes. Okay, so you can note this down: 11 equity, 16 debt, 6 hybrid, 2 solution oriented, and 2 other schemes. Now we're going to talk about what is large cap. This is a very important definitions. These are definitions that have been clarified by SEBI very recently. So you need to understand them so that you get to understand all these different 11 subcategories of equity schemes. Okay, so once you understand these, what are capitalizations? So large cap is the first to 100th company in terms of full market capitalization. Okay, so the highest market capitalization in India will be the first company, right, in large cap. Second, in terms of market capitalization, will be the second company here. The first 100 companies in terms of market cap. Mid cap will be the 101 to 250 in terms of full market capitalization. Okay, so large cap, then comes mid cap, next is small cap. So 251 and onwards in terms of full market capitalization ranking will be called as small cap companies. These are all listed on the exchanges. Okay, so large, mid, small, large cap companies will be mostly very less risk.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.